Right now, as you're watching this video, thousands of widows and widowers across America are losing half their retirement savings. Not because they made bad investments, not because the market crashed, but because nobody told them what to do before their spouse passed. And here's the part that really hurts. Most of this was completely avoidable. If you or your spouse is dealing with a serious illness, or if you're simply planning ahead the smart way, what you're about to hear in the next few minutes could literally save your family hundreds of thousands of dollars. This is not an exaggeration. The IRS has rules that most people have never heard of, and those rules are designed to collect big. But there are 4 specific assets you can move, restructure, or reposition before a spouse passes. And if you do it right, you keep the money in your family instead of handing it to Washington. Stay with me because this information is time sensitive and I'm going to walk you through every single one of them. Welcome to James Retires, the channel where we talk about the real stuff, the things your financial advisor might be too busy to explain, the strategies that actually protect your retirement, your spouse, and everything you've worked your whole life to build. If you're new here, hit that subscribe button right now and tap the bell so you never miss a video like this one. And if you've got a spouse, a parent, or a sibling who's retired or getting close to it, go ahead and like this video right now so the algorithm shows it to more people who need to hear this. Okay, let's get into it. Let me paint a picture for you. A couple, let's call them Richard and Susan. They've been married for 42 years. Richard handled most of the finances. They had a 401k, some IRAs, a brokerage account, and a life insurance policy. Richard passes away. Susan, grieving and overwhelmed, starts working with an estate attorney. And within the first meeting, she learns that because of how those accounts were structured, she's going to owe taxes that she never expected. Her required minimum distributions shoot up. A portion of the inheritance hits probate. And a policy that Richard thought would take care of her forever gets taxed in a way nobody planned for. She doesn't lose everything, but she loses enough that her retirement looks completely different than what they had planned together. That story is not rare. It happens every single day in this country, and it doesn't have to happen to your family. So let's talk about the 4 assets that need your attention right now. The first asset is the traditional IRA. Now, most people know what an IRA is, but very few people understand what happens to it at death, especially when one spouse passes and the surviving spouse inherits it. Here's the situation. When you inherit a traditional IRA from your spouse, you have what's called a spousal rollover option. You can roll it into your own IRA, which means you use your own age and your own required minimum distribution schedule. That sounds fine, right? But here's where it gets complicated. If the surviving spouse is younger and doesn't need that money right away, the RMDs, the required minimum distributions, eventually kick in based on their age and life expectancy. The money keeps growing, which sounds great, but it also means a larger taxable balance sitting there waiting to be taxed, often at a higher rate when the survivor eventually passes and non-spouse beneficiaries inherit it. The Secure Act changed the rules so that most non-spouse beneficiaries now have to drain an inherited IRA within 10 years. 10 years. That means your kids or grandkids could be taking large forced distributions that push them into higher tax brackets right in their prime earning years. The strategy here is to look seriously at Roth conversion before the first spouse passes. Converting a portion of a traditional IRA to a Roth IRA while both spouses are alive and filing jointly can be done at a lower effective tax rate than what the survivor might face later filing as a single taxpayer. Single filer tax brackets are not as favorable. The standard deduction drops. The same income that was manageable as a couple suddenly costs more in taxes when there's only one of you. So before that happens, converting strategically, not all at once, but in portions over a few years, can dramatically reduce the tax burden for the surviving spouse and for whoever inherits the account after that. Talk to a tax professional about your specific numbers, but do not let this one sit on the back burner. The IRA is almost always the biggest asset on the table, and it needs to be addressed first. The second asset is the brokerage account, specifically how it's titled and what the cost basis looks like. This one is huge, and most people walk right past it. When you own investments in a taxable brokerage account and your spouse passes away, something called a step-up in cost basis happens on that account. In most states, and for assets held jointly, the cost basis of those investments gets stepped up to the market value on the date of death. What does that mean in plain English? It means if you bought stock 20 years ago for $10,000 and it's now worth $200,000, your cost basis gets reset to $200,000. If you sell it right after that step-up, you owe 0 capital gains tax on that gain. 0. But here's what people miss, and this is critical. If that asset has already been transferred, retitled, or gifted away before death, you lose the step-up. If a spouse moves assets out of a jointly held account into an account held only in one name, specifically the name of the person who is not expected to pass soon, they may actually be giving up that valuable step-up in basis. Now, I want to be clear, every estate situation is different, and the step-up rules can vary depending on whether you're in a community property state or common law property state. Community property states like California, Texas, Arizona, and a handful of others have even more favorable step-up rules. So where you live matters enormously. The point is, before you move anything, before you retitle anything, sit down and figure out where the step-up is going to land, and whether what you're doing is helping or hurting. A CPA who specializes in estate planning can map this out for you in a single session. Do not skip this step. The third asset is life insurance, and specifically the structure of who owns the policy. Most people buy life insurance, name their spouse as the beneficiary, and think they're done. But ownership matters just as much as beneficiary designation. Here's why. If you own your own life insurance policy and you pass away, the death benefit goes to your named beneficiary, but it could still be pulled into your taxable estate for estate tax purposes if your estate is large enough. Now, the federal estate tax exemption is quite high right now, but there are proposals to reduce it, and state estate taxes can kick in at much lower thresholds depending on where you live. The solution that estate planning attorneys often recommend is an irrevocable life insurance trust, commonly called an ILIT. When a policy is owned by an ILIT rather than by you personally, the death benefit can pass to your heirs completely outside of your taxable estate. But here's the timing issue. You cannot create an ILIT and transfer an existing policy into it right before death and expect it to work cleanly. The IRS has what's called a 3-year look-back rule for life insurance transfers. If you transfer a policy and then pass away within 3 years, the death benefit gets pulled back into your estate anyway. So this is a move that needs to happen well in advance. Not when someone is in hospice, not when the diagnosis just came in. The earlier you restructure the ownership, the more protected the death benefit is going to be. If you already have life insurance and it's been in an ILIT for several years, you're in good shape. If it hasn't, this is a conversation worth having with an estate attorney right now. The fourth asset, and this one surprises people the most, is the family home. Real estate gets very emotional because it's where you raised your kids, it's where your memories are, and most people don't want to think about selling it or restructuring it. But the tax implications of getting this wrong are real and significant. When a spouse passes and the surviving spouse inherits the home, there is generally a step-up in basis on at least half the property, and in community property states, often on the full value of the home. That's helpful if the survivor eventually sells, but the problem arises later, when the surviving spouse also passes and the home transfers to the next generation, or if the surviving spouse needs to sell the home to fund long-term care. Depending on how the property is titled, how long it's been held, and what state you're in, the tax consequences can vary widely. One strategy that some families use is placing the home into a trust, either a revocable living trust to avoid probate or for larger estates, an irrevocable trust that can provide additional asset protection. Another consideration is whether both spouses have used the primary residence exclusion recently. That's the rule that lets you exclude up to $500,000 in capital gains when selling a home you've lived in for at least 2 of the last 5 years. That exclusion is $500,000 for a married couple, but only $250,000 for a single filer. So if a surviving spouse waits too long to sell after the death of a partner, they may lose access to the full exclusion. The clock is ticking and most people don't know it. Again, every situation is different. The right answer depends on the value of the home, how much gain is in it, what state you're in, and what your long-term plans are. But the wrong answer is doing nothing and assuming it all works out. It often doesn't. Now, I want to take a step back and connect these 4 assets together, because the real message here is that planning in isolation never works as well as planning holistically. The IRA conversion strategy might affect how much room you have in a given tax year for other moves. The step-up in basis on the brokerage account might influence how you think about selling certain positions. The life insurance structure affects your overall estate size. The home affects your liquidity and your legacy. All of these pieces move together, and the families who come out ahead are the ones who sit down, ideally with a team that includes a CPA, an estate attorney, and a financial advisor who actually communicates with each other and map out the whole picture before something happens. Not after, before. One more thing I want to mention, and this is important for people who are watching this because a spouse has already passed and they're now the surviving spouse. You may still have options. There are actions you can take as the sole surviving spouse that can reduce your future tax burden, restructure how you're receiving income, and make sure the next transfer to your kids, to your grandkids, to whoever comes after, happens as efficiently as possible. You are not out of options. The time to move is now, not later. At James Retires, we try to give you the information that actually moves the needle, the stuff that makes a real difference in the numbers at the end of the day. If this video helped you understand something you didn't know before, I want to ask you to do one thing. Drop a comment below and tell me. Which of these 4 assets do you think is the biggest blind spot for most families? I read every single comment, and I genuinely want to know what you're thinking. And if you know someone, a parent, a sibling, a friend who is married and hasn't done any estate planning, please share this video with them. I'm not exaggerating when I say this information could be the difference between their family keeping hundreds of thousands of dollars or watching it disappear into taxes and probate fees. Share it. It matters. And as always, thank you for watching James Retires. We'll see you in the next one.